So let's talk about the different types of stock markets. Well, first of all, there are two leading stock markets, and they are the New York Stock Exchange and the NASDAQ stock market. There are just two basic types of stock markets. There are physical location exchanges, which include the New York Stock Exchange, and electronic dealer-based markets, that includes the NASDAQ stock market. And it also includes the less formal over-the-counter market, and then additionally it includes the recently developed electronic communication networks, which are called ECNs. The physical location exchanges are formal organizations having tangible physical locations, like a building, and trading in designated securities. There are exchanges for stocks, bonds, commodities, futures, and options. The physical location exchanges are conducted as auction markets where securities go to the highest bidder. Buyers and sellers place orders with their brokers, who then execute those orders by matching buyers and sellers, although specialists can assist in providing continuity to the markets. Then we have the electronic dealer-based market, which is made up of hundreds of brokers and dealers around the country who are connected electronically by telephones and computers. The dealer-based market facilitates trading of securities that are not listed on a physical location exchange. A dealer market is defined to include all facilities that are needed to conduct securities transactions not made on the physical location exchanges. These facilities include, first, the relatively few dealers who hold inventories of these securities and who are said to make a market in these securities. Second, the thousands of brokers who act as agents in bringing the dealers together with investors. And third, the computers, terminals, and electronic networks that provide a communication link between dealers and brokers. Dealers continuously post a price at which they are willing to buy the stock, which is called the bid price for them, and a price at which they are willing to sell the stock, which from their perspective is called the ask price. The ask price is always higher than the bid price, and the difference, also known as the bid-ask spread, represents the dealer's markup or profit. So we have a situation here where we're looking at if Apple Computer decides to issue additional stock with the assistance of its investment banker. An investor purchases some of the newly issued shares. Is this a primary market transaction or a secondary market transaction? Well, the key thing is that these were new additional shares. So this is a primary market transaction. And then the second question is, what if an investor buys existing shares of Apple stock in the open market? Is this a primary or secondary market transaction? Since they are existing shares and no new shares have been created, then this is a secondary market transaction. And then you've probably heard about initial public offerings, which is an IPO. And this occurs when a company issues stock in the public market for the first time. It's called going public, and it makes companies' owners able to raise capital from a wide variety of outside investors. And then once they're issued, that stock trades in the secondary market. Here's just an example of the returns from 1968 to 2012 for the S&P 500. And you can see that most years the S&P 500 is up in the blue rather than down in the white, where you have losses. You can see that, well, kind of close to 1975, stock returns were about 35%, but in 2008 we have about a negative 35% return. So the stock market goes up and down, and that's why you should never look at your portfolio every day, because when you see it going up and down every day, it becomes psychological for you and you want to pull your money out if you see that you're losing money. When overall, it's better just to leave your money, because you can see over the long term you end up with a good return, overall average annual return in the stock market. And plus, you're trying to also earn enough money to beat inflation so that your purchasing power is kept preserved by the time that you retire. Now, it would be horrible if you were retiring in 2008 and you'd lose, 35% of your money right at that moment. So that's why you don't want to have all your money invested in the stock market. Over time, as you get older, you want to switch from stock investments over to safer investments or more stable ones like bonds, or even to getting to more liquid things like certificates of deposit as you get much older. And then what does it look like when you look up a stock quote? And this is finance.yahoo.com. Down here you can see the URL. And what you do is you type in a ticker symbol. Facebook, the ticker symbol is FB. And this is from February 19th, 2013. And you can see that the price for Facebook is $29.03 at 3:03 p.m. right at that particular second when the screenshot was taken. Some interesting things that we could look at would be that the days range, which is graphed on this chart right here, is that it opened at $28.19, and let's see, the range for the day has been $28.12 to $29.08. So it's almost like a dollar fluctuation within the day. You can see the earnings per share is 2 cents. There is no dividend that's paid, so that's not applicable. The volume for the number of shares traded today or this day is 33 million, which is quite a large volume. You can look at the last year's range of prices. And so in the last year it traded from $17.55 up to $45. So you can see that's kind of a big fluctuation in price over the last year. The 1-year target estimate is that analysts are hoping that the stock will reach $33.59. And they did this by using the time value of money and valuing a stock, which occurs later on in Chapter 5 and the stock chapter. The beta for the stock is 1.7, which means that it is more volatile than the market, and we'll talk about that later too. So let's see what Facebook is today. Well, today for me is May 27th, 2015. And I want to go finance.yahoo.com. And I'm going to click here in this quote lookup, if it would let me, and type in FB for Facebook. And it is a whopping $80.10. And the 1-year target estimate at this point is $95.47. So let me go back to that PowerPoint. Okay, so February 19th, 2013, that's a little over 2 years ago, it was $29. And then right now, it's $80.13. And you can see this little green thing is kind of, the price is updating pretty much by the second. So this would have been a very good investment. I wish I would have invested in it myself. But that's a pretty easy way. If I wanted to look up a different one, see what Apple's doing, type in, and you can just, if I didn't know the ticker symbol, I type in Apple and it brings up Apple. Apple's selling for $131.99 right now. And if I went back to Facebook and I clicked on the graph, it's going to show me a history of the price, and I can choose the history. I don't want the 1-day history. Let's go back to 5 years. And so you can see that on August 20th, 2012, the closing price was $19.41, whereas where we are, which day? May 18th, 2015, the closing price was $80.54. So this is like a great kind of graph you would want to see for the stock. Now right here where the stock price went up and then it went down, you might have been freaking out, but that's why you just let it go for a while. Like the Frozen song, you just let it go. What you're trying to do is be a long-term investor. And over time, you should, reap the rewards of holding your investment long term. Now, if the company went bankrupt tomorrow, then you would lose everything that you have. And that's a risk that you have by investing in the stock market. So there's all kinds of information on the Yahoo Finance website, or there's lots of other websites too. So let's go back. And now you know how to find some information for a stock.